So far, we've learned about different types of investments, like stocks, bonds, and real estate. But a big question remains: how do you actually put it all together? How do you pick the right mix, and who manages it all? Doing it completely yourself is an option, but it takes a lot of time, knowledge, and ongoing effort. Today, let's talk about the simpler path, letting professionals help you through what's called managed investments. First, let's recap why managing investments yourself can be a big task. It's not just about picking what to buy. Once you own investments, you need to monitor them. You also need to rebalance your portfolio from time to time. Rebalancing is a simple but important idea. Let's say you decide to split your money equally between two investments. Over time, one might grow faster than the other. That investment will become a larger percentage of your portfolio, which means you're taking on more of its specific risk. Rebalancing is the process of selling a little of what has grown a lot and using that money to buy more of what hasn't grown as much. This brings your portfolio back to your original plan. In doing this, you are quietly following the classic advice: buy low and sell high. You sell a bit of the investment that's high, the one that grew, and buy more of the one that's relatively low. It's a disciplined way to manage risk, but it requires attention and a steady hand. Now, if that sounds like too much work or too much stress, that's perfectly okay. Most people don't want to be full-time portfolio managers. This is where professional help comes in. You can pay a fee to have experts handle the picking, monitoring, and rebalancing for you. These services are called managed solutions. For a beginner, this is often the smartest and most peaceful way to start. The most personalized type of help is called discretionary management. This means you hire a dedicated portfolio manager. You tell them your goals, your timeline, and how much risk you're comfortable with. They then build and manage a custom portfolio just for you, making all the decisions on your behalf. It's a full-service, hands-off approach. The catch? It usually requires a very high minimum investment, often several $100,000. For most people starting out, this door is closed. So how can an everyday investor with a few $1,000s get professional management? The answer is through funds. A fund is a brilliant solution. It pools together money from thousands of individual investors. A professional manager then invests that giant pool of money into a diversified portfolio of stocks, bonds, or other assets. When you invest in the fund, you own a piece of that entire portfolio. The most common type you've probably heard of is a mutual fund. You can buy into a mutual fund with a relatively small amount of money, sometimes as little as $100 or less. You get instant diversification and professional management for a single fee. Instead of you trying to buy 50 different stocks, the mutual fund manager does it for you and all the other investors in the fund. It's efficient, simple, and accessible. There are mutual funds for every strategy. Some focus on large U.S. companies, some focus on bonds, some focus on international markets. You can choose a fund that matches the level of risk you want to take. The fund's manager and his team handle all the research, buying, selling, and rebalancing. Your job is simply to choose a fund that fits your goal and keep adding money to it. Now, mutual funds have a cousin that you also need to know about: the hedge fund. You might hear this term in the news. Hedge funds are also pooled investment funds, but they are for wealthy, accredited investors. They can use much more complex and risky strategies, like heavy borrowing or investing in distressed companies. They are less regulated and less transparent. For the vast majority of beginners, hedge funds are not relevant or appropriate. They're part of a different, high-stakes world. For you, mutual funds and their modern sibling, exchange-traded funds, or ETFs, are the essential tools. They democratize investing. They give the small investor the same buying power and professional management that was once only available to the very rich. The fee you pay, called an expense ratio, is a small price for the diversification, expertise, and convenience you receive. It's important to understand that when you buy a fund, you are not getting a custom portfolio. You are buying into a pre-built strategy. That's okay. Your customization comes from how you combine different funds. For example, you might put 60% of your money in a total U.S. stock market fund and 40% in a total bond market fund. That's a complete, diversified, professionally managed portfolio in just 2 holdings. The evolution of managed solutions continues today with robo-advisors. These are digital platforms that use algorithms to build and manage a portfolio of ETFs for you. You answer questions about your goals and risk tolerance, and the software does everything else. It picks the funds, allocates your money, and automatically rebalances. It's a low-cost, streamlined version of professional management, perfect for the digital age. So what's the takeaway for a beginner? You don't have to be an expert stock picker. In fact, trying to be one is often a distraction. The proven path is to use the tools built for everyday people, mutual funds and ETFs. Whether you choose them yourself or use a robo-advisor to do it for you, you are leveraging professional management to build a solid, diversified portfolio. This approach lets you focus on what you can control: how much you save, staying patient, and keeping your costs low. The fund managers handle the complex work of analyzing companies and markets. It's a partnership that has helped millions of people build wealth steadily over time, without needing to watch the financial news every day. Start by looking for a low-cost, broad market index fund from a reputable company. An S&P 500 index fund or a total stock market fund is a classic, simple foundation. From there, as you learn more, you can add other funds to fine-tune your portfolio. But the core idea remains: let professionals handle the intricate job of security selection, so you can focus on your life and your consistent saving habit. Remember that investing is a marathon. The goal isn't to outsmart the market every day. The goal is to participate in the long-term growth of the global economy in a simple, low-stress, and cost-effective way. Managed funds are the vehicle that makes this possible for everyone, no matter how much or how little you start with. Thank you for joining me at Invest Easy 101. If this explanation helped clarify how professional investment management works for the everyday person, please subscribe. We're here to make your first steps in finance clear and confident. Let us know what you'd like to learn about next in the comments.